Jim Paulsen, the Chief Investment Officer at the Leuthold Group. Jim, always great to catch up with you, buddy. Your line, and I want to start right here. My overall guess is that the stock market correction is over. Jim, what indicates that?
Well, you know, I'm nervous like everybody else, and I see all the issues we have, which is pretty plentiful. But I kind of think that if you just get away from the issues for a minute, I think we've been through a very conventional standard correction here. I think it started about a year ago when yields peaked in March of last year, and most markets have been flat over that period of time. S&P 500, Russell 2000, international markets. And now we've had an official correction here in the last couple of months, and that's right on time. If you go back about in the second year of most expansions, we have a period where the market goes flat and corrects. We did that in 83, 84, we did it in 93, 94, we did it in 2004, we did it in 2010, 11, all about at the same time. And they all lasted for about a year. That's where we are. And corrections it's done what corrections do. It took the concentration of leadership out of the market from new era tech stocks and reduced our dependency on a few handful of companies. It paused the rate route, which is now coming back. It revalued most parts of the marketplace pretty significantly, and it gut checked sentiment. All sentiment majors are very pessimistic at the moment. But I think it left economic and earnings fundamentals fairly strong. And the combination of pessimism, which is really elevated after about a year of going nowhere, and with strong fundamentals, I think is a buying opportunity for investors.
Jim, what you just said is possibly the most radical thing that I've heard all day, which is that this is normal. That what we're seeing right now is normal behavior in markets. It is hard for me to find the normal here, not only from the market behavior, but also from the exogenous risks and the exogenous effects, and the fact, and perhaps more importantly, that the Federal Reserve is not going to perhaps act as the put that they have in the past. How does that factor into your thesis that this is normal?
Well, almost every correction that I mentioned in the past, 83, 84, 93, 94, those were associated with periods where inflation started to pick up, yields started to go up, the Fed started to tighten. Very similar in that regard to what we have today. Now, we've added an additional exogenous risk with Russia. I think the big elephant in the room here is inflation. That is the issue. It's not Russia, it's inflation. And here's how I look at inflation. I look at it as made up of different components, and I think it's important to look at the distinctions. If I look at one component, which is the smallest part of inflation, it's Russia. And yes, it's having an influence, but it's a small influence relative to that 8% figure we have on CPI, and it's likely to be transitory. I mean, it may not be, but I think it will be largely transitory. The second component is we stimulated demand too much with overly aggressive economic policies, and that's got a chunk of what we're dealing with as well. But there's good news on that, because those same aggressive economic policies have turned decidedly restrictive in the last year. Real M2 money growth was 25% a year ago. It's 6% now. Real deficit to GDP ratio was 18.5% a year ago, March. It's 10.5 today. The 10 to 2s yield curve was 160 a year ago. It's 25 today, and the dollar's up almost 10%. So there's tightening in those policies, which should lower the inflation rate as we go through the rest of the year. And lastly, I'll just real quick, we're moving this pandemic to an endemic. And the real problem is the biggest chunk of inflation has been a supply side problem due to COVID restricting the labor supply. If that eases, we're going to see delivery times come down. We're going to see backlog orders come back to normal. We're going to see airline miles go up to normal. And we're seeing the labor force really start to move up in recent months as Omicron has come down. So I still think that inflation is going to moderate a fair amount, and that might slow the Fed's need to tighten and all those concerns that we currently have.
Jim, you mentioned the yield curve in 2s, 10s hanging in the ballpark of 20 to 25 basis points. The view from Morgan Stanley is that's probably heading toward inversion, but the equity market is going to be able to look through it, to withstand it, because it's not going to indicate a recession. Are you in that camp?
I will be concerned if the 10s to 2s inverts, because it's been a good sign of past inversion. It won't be the only thing. Here's what I'd say about the 10s to 2s. If you go back to the 1960s and look at the 10s to 2s and compare it to the 10s to 3 months or the 10s to funds, what you'll find is the 10 to 2s and the 10 to funds was in the same place at the same time every previous cycle. That is, when the 10s to 2s was 25 basis points, so was the 10s to 3 months. That is not the case today. Today we got 150 basis points on the 10s to 2 or 10s to 3 months, and we've got 25 basis points on the 10s to 2s. I think that is telling me that the market's way ahead of it of discounting the actual yield curve of 10s to cash. The 10s to cash yield curve will catch up, but it might take the rest of this year to do that. And so I think the 10s to 2s might stay put as the rest of the yield curve catches up, rather than the 10s to 2s going to inversion. But that's just my guess.
Jim, I've missed you, mate. It's been too long. Thanks for being with us.